In the Autumn Budget 2024, the government announced significant changes to how pensions will be treated for inheritance tax, known as IHT, set to take effect from April 2027. In short, pension funds, which are currently free of IHT, will become liable to it from that date. These proposed changes are subject to further consultation, so the final shape of this proposed new legislation is not yet set in stone. However, the fact that this is even proposed is enough to shake up financial planning for individuals and their families. This has many implications. We will highlight a few examples. The current rate of inheritance tax is 40%, meaning that any pension fund assets that is caught in the net could be taxed at this level. Inheritance tax is applied once an estate value is above what is called the nil rate allowance, and each individual has a basic allowance of £325,000. This means a married couple have £650,000 in total. This is the basic amount where there is no liability to inheritance tax. For those people who own residential property, there is a further allowance of £175,000 per person, taking the potential total allowance to £500,000 for an individual or £1 million for a couple. All these allowances have been frozen until 2030, meaning they will stay at these levels. Let us now look at some examples. An individual married with children has the following assets in 2025, totaling £1,400,000. It is feasible that given current thresholds and assuming the spouse has no further assets of his or her own, there will currently be no liability to IHT on this estate. The combination of the thresholds being frozen and pensions being brought into the net can be explosive. For instance, if the assets and pensions funds rise by 20% by 2030, in this case, it is feasible and likely the IHT liability will be 40% of £680,000, which is a potential tax bill of £272,000. It has not only created a liability where there was none before, but also a significant one. Let's now look at a situation where the further allowance of £175,000 relating to property may be impacted. This extra allowance can be reduced once total assets exceed £2 million, so the pension fund could tip the scales, not only becoming taxed in its own right, but impacting the allowance, a double whammy. Currently, at or after retirement, it is common for individuals to draw income from their assets which may be subject to IHT and leave the pension to keep accruing value, as it is not in the calculation. Such a strategy that works well based on the current rules may not work so efficiently under the new proposed rules after 2027. There are other impacts beyond these examples. The clear message is that even the idea of this changing alters how you might best approach your planning. IHT is always something that needs to be tackled well in advance and balanced against many factors, and is going to vary from individual to individual based on circumstances. Although the proposed date for the new rules is not until 2027, the need to review plans is now to see what effect this would have. If you have significant pension fund assets, it is sensible to get ahead of this at the earliest possible date. At Interface, we are here to help you with an individual review, helping you to assess how this may affect your decision-making.